The company Yelp, a website known for its user-created restaurant reviews, is going public today. I'm Louise Story, reporting for Business Day Live. Yelp's initial public offering was priced at $15 a share last night, valuing the company at nearly $900 million. I'm joined by DealBook's Evelyn Roosley, who has been covering the story. Hi, Evelyn.
Good morning.
So there have been a number of technology IPOs in the last few months, and of course we're waiting to see what will happen with Facebook. What does Yelp's tell us?
Well, the second half of 2011 was very choppy. We saw some of the recent offerings really pull back in their stock prices. Recently, that's stabilized. Now, Yelp going public today and having a very strong debut. It rose as much as 70% in the first hour of trading, of when it started trading. Exactly, is a very positive signal for the market. It should be an indication that investors, IPO investors, are willing to take on more risk, and so that should bode well for other tech offerings later this year.
We're joined now by Jeremy Stoppelman, Yelp's CEO, from the floor of the New York Stock Exchange. Hi, Jeremy.
Hello there.
I know it's a big day for the company down there, but let's get down to business. And my question is, how are you going to ward off competition? Aren't companies like Google creeping into the online review space?
You know what Yelp's got that's very unique to the space is this community built out in 71 different markets. We're the ones that have really gotten that right, and as a result, the community generates an enormous amount of content that no one else has. We have unparalleled breadth and depth. So tons of reviews. We have 25 million reviews, generating about 1 million every single month. And so that's an advantage when you're trying to solve the problem of what's a great local business. You need that word of mouth information, and the best place to get that, the one that has the most useful information most of the time, is Yelp.
Hi, Jeremy. It's Evelyn Roosley here from the New York Times. It's an exciting day for you guys. What did you think about in terms of timing for today? You know, we were coming up off a very volatile second half of 2011. What were some of the factors that was weighing on your decision to go public today?
You know, there's a saying that a good business can go public whenever it wants to, and so we really didn't think about the macro environment. We were just focused on what's the right time for the company, when did the story really start to make sense for public company investors, when did we feel like we had revenue dialed and at the size that we thought was appropriate for the public markets. And so the time is right, the time is now. It's a good opportunity to take in capital and continue to grow this business internationally, on mobile and beyond.
Now, Jeremy, one of the questions I always ask founders that go public is, you know, how does this change the game? And oftentimes they say it doesn't, it's just another point in their long timeline, but it has to change the dynamic. So what are you thinking about in terms of employee retention? How do you plan to move forward now that you guys will be scrutinized on a quarterly by quarterly basis?
I think as managers, if we're doing our jobs, then nothing should change. We should continue doing our business. This is just one chapter that is, you know, in an overall book. We're just writing the story. We're at the beginning. There's enormous upside. It's a huge market, $100 billion annually spent on local advertising, about $20 billion spent on Yellow Pages. We're scratching the surface. We just have 24,000 advertisers at this point. Like, they're generating $83 million in revenue, but there's huge upside. We're just getting started. There's millions of local businesses that we can reach out and have a relationship with.
And any idea when you guys will be profitable?
In the fourth quarter, we were already adjusted EBITDA break even, so that shows that there's leverage in the model and it's starting to work. We're not burning a lot of capital as a result. We are investing heavily in our sales force as well as overseas. So we'll continue to invest for growth, but the company has leverage in the model that's starting to reveal itself.
Well, thank you, Jeremy, so much for joining us, and thanks, Evelyn. We welcome back Jim Stewart, who writes the Common Sense column for The Times. This week he takes us behind the scenes at NBC, a network that has been struggling with television ratings. The network has been boosted recently by the reality show The Voice. For those of you who may not have seen that recently, we have a clip of the show.
I've really been waiting for something to come along and excite me as much as you did, and you did that to the point where at the end I just wanted to grab a mic and get up there and sing it with you, because I love that song.
Oh my God, please do! I'm going, come on!
Can I get it?
Come on.
Okay.
Whoa!
Here we go.
Jim, I always sort of thought that I was behind the scenes by watching 30 Rock, but tell us what you found out when you went behind the scenes of the NBC program this week.
Well, first of all, this is really a seismic shift in the entertainment landscape. A new #1 show, The Voice, displaced the long title holder American Idol. But these things don't happen by accident, and this is a huge opportunity for NBC. It's also a huge challenge. It's all the more surprising because they were so far behind. And to me, it was so much fun to get in there to see the decisions that really led to this. It takes a lot of risk-taking, it takes a lot of money, and in the end, it really takes a lot of luck.
So NBC, they have a new owner, Comcast. They were sold last year. I mean, is there more of a push for profits there than they've had in the past?
Well, I think Steve Burke, who was COO at Comcast, is now the chief executive at NBC, is really putting all his energies there. I think it's both a big financial push, but even more than that, it's a reputational push. I mean, also, let's face it, cable companies face a very challenging future given the evolution of entertainment, and this is a really, really big bet on content creation by Comcast. So this is vitally important that they succeed, and The Voice is really their first big opportunity and their first big test since Comcast took over.
So let me ask you, you talk about all these different NBC executives looking at the television ratings, and I had to scratch my head a little, because we are in the 21st century and a lot of people, young and old, are watching videos online on the internet. And so do you think these ratings even mean anything anymore?
Well, they're still the benchmark. I mean, people in the entertainment industry obsess over them, and I think they're still, although very unscientific, probably the best indicators that we have. Nobody has figured out exactly how to track all the different ways people are watching. They know they are doing it. It's changing the nature of television viewing tremendously, but these ratings still seem to be the best proxy for total viewership, total reach, and total impact for advertisers, especially in this much sought after 1849 demographic.
And what about NBC, the rest of the lineup? I mean, they have this reality show, The Voice, but one show does not a network make. What else do they have going on?
No, both The Voice and the Super Bowl have helped NBC get out of last place by a few tenths of a point, but one show is not going to do it. And this will be fascinating to watch how they use the platform of The Voice to try to boost the rest of their lineup. Now, they've put this show Smash on right afterwards, which is about the behind-the-scenes making of a Broadway musical, and it's critically acclaimed. It's beautiful. It's beautifully produced. It's very expensive, but the critics say, well, it's a very narrow show. This is not another Voice. What can The Voice do for it? And then will they have opportunities to move other shows after that platform? So it'll be very, very interesting to see how NBC takes advantage of this gift that just landed in their laps.
Well, Jim, we'll stay tuned. Thanks so much for joining us.
Thank you.
As we reported earlier this week, the New York State Comptroller released his annual report on Wall Street compensation. Banks have gotten used to people paying close attention to their pay because back when they received the government bailout, they had to report their bonuses to the Treasury Department. I'm joined now by Columbia University professor Robert Jackson, who was one of the lead people at Treasury overseeing pay. Hi, Robert.
Hi.
So let me ask you, it's almost 4 years after the financial crisis. Has Wall Street changed its ways?
Well, this comptroller report does provide some sign that cash compensation for the average banker is down on Wall Street. But this report gives us only a limited picture of compensation because it only includes cash bonuses, and as we know, increasingly bonuses are paid in stock on Wall Street. We only get a limited picture from this report, but at the moment it does seem that banker pay has decreased.
I got to ask you, when you were plowing through all those different documents with the pay from places like Citigroup and AIG, what was the biggest surprise when you were down there in Washington?
I think what surprised me the most was the extent to which the boards of directors of these large banks didn't really have a grasp of what was happening at the lower levels of the company.
Like the traders?
Yeah, exactly.
The salespeople?
What we found was that it was very difficult for boards of directors to get their arms around how those folks were getting paid. And sometimes we'd ask very basic questions about the bonus structures for people who were taking pretty substantial risk. And it was very hard.
Well, because the traders, sometimes a trader could put on a $100 million or multi-billion-dollar trade, and you're saying the boards weren't really looking at their pay packages.
That's absolutely right. In the Wall Street of the past, those bonuses were really left to management. And to give you one big example that was out in the media a great deal, Andrew Hall of Citigroup, formerly of Citigroup, I should say, was somebody who was putting on very substantial risk, and his bonus was more or less unregulated by the
board wasn't looking at it. So you've been doing a lot of research since you left the Treasury Department, looking at Goldman Sachs bonuses and their pay practices going back many years. What have you found?
Well, What I've been studying recently is whether or not bankers who receive stock as compensation actually hold on to those shares over the long term, giving them reason to increase the firm's value. Now, Goldman is one of the best governed firms on Wall Street, and they have sort of a best case scenario for the extent to which bankers will hold on to stock that we pay them in to give them reason to increase firm value. But I find that even there, the bankers at Goldman do unload, do sell a huge amount of the stock that they're granted as compensation.
So the bank gives them the stock so that their incentives are aligned with the company. So if they want the company to do well, and you're saying they've been massively unloading it.
That's right. Well, what I would say is that in response to receiving new shares, the bankers are inclined and allowed to sell old ones. And even at Goldman, which is really your best case scenario for that type of an arrangement, you have a great deal of unloading. And I would expect that at other banks, it's far worse, actually.
Now, what about the Federal Reserve? They've been looking at pay policies, and they have to write some rules. Where do those rules stand?
Yeah, there's a new section under the Dodd-Frank bill that empowers the Federal Reserve and the SEC, among others, to enact new rules that limit banker pay. And one of the disappointing things about the rules, they were released last April, is that they don't do anything to stop bankers from engaging in this kind of unloading. So
dumping their shares.
That's right. And even basic things that you'd think would very clearly be restricted. For example, bankers hedging the stock of their own companies. Even that's not restricted.
Hedging means if they also bet against the stock so that they cover their risk.
Exactly. So if a banker's given new shares, they're still allowed to take bets against.
So the Fed
those
did
shares.
not address hedging. They did not address selling of shares by executives. They just left that out of the rules completely?
That's right. Now, to be fair, the banks themselves, to give you an example, Goldman has restricted hedging on its executives for many, many years, and other leading banks have taken that step. But what's striking to me is that in this way, the Fed's rules are even behind the bank's own practices on compensation.
So they're kind of leaving it to the industry, as has long been a practice among regulators.
I think that's right, and I think we learned during the financial crisis why that's not a good idea.
So is anyone else still under the thumb of the Treasury Department, or have they all, have all the banks escaped the watch of Treasury?
Most of the large banks are now out of Treasury's purview. So we had the Office of the Special Master, and we still do have an Office of Special Master that keeps an eye on compensation at, for example, AIG. But the other large banks like Citigroup and Bank of America have repaid their top
They're free to
funds.
do what they want.
They are, yes.
Well, thanks so much for joining us.
I'm glad to be here.
That's all for today. Please stay with us online at nytimes.com for our continuing coverage of this and other stories. I'm Louise Story, reporting for Business Day Live. Thanks for watching.